Every few months, some headline blows up online. 401k is a scam. The government controls your money. You'll never see it. People share it, freak out, and start making financial decisions based on something a stranger wrote to get clicks. Here's the thing. Most of that is garbage, pure fear-mongering for people who've never actually looked at the numbers. But here's what nobody talks about. There are real, legitimate, mathematically sound reasons why the traditional 401k might actually be the wrong move for your next dollar. Not conspiracy theory stuff, not clickbait, just math. And that's exactly what we're getting into today. Because the question was never, is the 401k a scam? The real question is way more useful than that. Giving your tax bracket now, your expected bracket later, your timeline, your savings rate, where should your next dollar actually go? Sometimes that answer is the traditional 401k. Sometimes it's a Roth. Sometimes it's a taxable brokerage. Sometimes it's paying off debt first. The goal isn't to scare you. The goal is to get you thinking intentionally instead of just letting your employer's default settings run your retirement on autopilot. Before we get into the situations where it works against you, let's be straight about something. The 401k is genuinely one of the most powerful wealth-building tools ever created for regular working people. Fidelity's Q2 2025 data shows there are now 595,000 401k millionaires in America, all-time high. That number jumped 16% in a single quarter. These aren't people who got lucky on some meme stock or inherited a beach house. These are workers who showed up, contributed consistently, and let compound growth do its thing over decades. The average 401k balance hit $137,800. The average combined savings rate, employee plus employer, sits at 14.2%, right up against Fidelity's recommended 15% target. And the employer match? That's a guaranteed 50 to 100% return before the market does a single thing. No other investment on the planet offers that. Not index funds, not real estate, nothing. So when someone tells you to ditch your 401k entirely, they're leaving money on the table and calling it wisdom. But here's where it gets real. A great tool used at the wrong time for the wrong reasons in the wrong situation still gets you the wrong result. So let's talk about exactly when the math flips. The first situation is when you're a high saver staring down a future RMD problem. This one surprises people. You did everything right. Maximized contributions for 30 years, account grew into 7 figures, you're supposed to win, and then required minimum distributions kick in and the math completely flips on you. RMDs are mandatory withdrawals the IRS forces out of your traditional accounts once you hit a certain age. Under Secure 2.0, that's 73 if you were born between 1951 and 1959, and 75 if you were born in 1960 or later, starting 2033. The whole pitch of traditional 401k contributions is take the deduction now, pay taxes later at a lower rate. That assumption works great unless you saved so well that your RMDs push you into a higher bracket than you were ever in while working. Morningstar and Vanguard research both show this happens more than people expect. Your account keeps compounding. RMDs go up every year. Your tax bill goes up every year. Social Security gets partially taxable. Medicare IRMAA surcharges kick in above certain income thresholds. The whole thing snowballs. If your projections show future RMDs landing you in the 24 or 32% bracket, and you're sitting in the 22% bracket today, you're not deferring taxes. You're deferring a bigger tax bill. That's not a strategy, that's a delay with interest. The second situation is when your income is going up, not staying flat. This one hits hardest for people in their 20s and 30s. Early career, you're earning less. You're in the 12 or 22% bracket. A traditional 401k contribution saves you taxes at those rates right now. Sounds smart. But here's the problem. If you're a professional climbing a career ladder, your income probably isn't staying at $60,000. Research is pretty consistent on this. Workers whose earnings rise over time, which describes most college-educated professionals, often generate more lifetime after-tax wealth from Roth contributions than traditionals. Real example, someone starts at $60K. Income grows 2% annually, totally normal. 20 years later, they're earning $140,000, sitting in the 24% bracket or higher after bonuses. Traditional contributions throughout their career saved them taxes at 12 and 22%, but RMDs force withdrawals taxed at the higher bracket they climbed into. Roth would have worked better. Pay taxes at 12 or 22% when you're young, everything grows tax-free. Withdrawals and retirement completely tax-free regardless of what bracket your RMDs would otherwise push you into. And get this, Fidelity data shows that even though 94% of employer plans now offer a Roth 401k option, only 16.2% of eligible workers actually use it. The people who do skew younger. They figured out the math early. The TIAI Institute found that workers in the bottom 3 tax brackets early in their careers benefit most from Roth as their income climbs. Same savings discipline, completely different tax outcome over a lifetime. The third situation is when you need your money more than you need a tax deduction. Nobody wants to talk about this one because it's not dramatic, but it's real life. If you don't have an emergency fund, if you're carrying high interest debt, if you're saving for a down payment, if you're one bad month away from serious financial stress, locking every available dollar in a 401k is not your smartest play right now. The sequence for anyone who needs stability first. Build a real emergency fund, at least 3 months of expenses. Pay down any debt above 15% APR. Fund an HSA if you're eligible because it carries triple tax advantages and you can access it for medical costs at any time. Then consider building a taxable brokerage where you can reach your money without penalties. And yes, always capture the full employer match first. That's free money, and walking away from it makes no mathematical sense. But beyond the match, the next dollar might genuinely serve you better somewhere more accessible. The fourth situation is when you're planning to retire early. If you're aiming for the exit in your 40s or early 50s and your plan doesn't offer the rule of 55, your 401k money is locked until age 59 and a half. That's a serious problem when you need income at 47. The rule of 55 lets you take penalty-free withdrawals from your most recent employer's 401k if you separate from service in or after the year you turn 55. Not every plan offers it. Check yours. For early retirees, the smarter build is a taxable brokerage account running alongside your retirement accounts. No contribution limits, no access restrictions, no penalties ever. You pay taxes on capital gains on growth, but long-term capital gains rates are 0, 15, or 20% depending on your income, and only the growth gets taxed. Your contributions come back clean because you already paid taxes on them going in. Use the brokerage to cover your early retirement years from 45 to 59. Then top traditional accounts once penalty-free access opens. You bridge the gap instead of leaving a hole in your timeline. The fifth situation is when your plan's fees are quietly eating your future. Some 401k plans are excellent, low fees, solid index funds, institutional share classes you couldn't access on your own. Others are genuinely bad. High fees, limited investment choices, expensive actively managed funds that underperform anyway. Average total plan costs run about 0.52% across the industry, but that average hides a lot. Large employers with over 1,000 employees typically run 0.4 to 0.6%. Medium plans hit 0.7 to 1% all in. Small plans under 100 employees often run 1.0 to 1.75% all in. The Department of Labor modeled what that actually costs you. Take a $25,000 starting balance earning 7% annually over 35 years. At 0.5% in fees, you end up with around $227,000. At 1.5% in fees, you end up with $163,000. That 1% difference destroys 28% of your potential balance. Not in 1 year, every single year, compounding in reverse. If your plan charges above 1% in total fees, or if every investment option is an expensive, actively managed fund, capture the match and then redirect the rest to an IRA with low-cost index funds. Keep expense ratios under 0.1% and let the math work for you instead of against you. The sixth situation is when your Roth conversions are already part of your long-term plan. If you know you're going to be doing Roth conversions down the road, maybe during a sabbatical, between jobs, or in those years right before RMDs kick in, it might not make sense to keep piling more into traditional accounts right now. Here's the logic. You defer taxes today by contributing traditional. Then you convert those dollars later and pay taxes on the full amount, including all the growth that accumulated in between. You've essentially deferred now only to pay more later on a bigger number. If conversions are in your plan, shift contributions to Roth today. You slow the growth of your traditional balance. Future RMDs stay manageable. You create more room to convert at lower tax rates when the window opens. The smaller your traditional balance when you hit your 60s, the cleaner the conversion strategy gets. You can target specific brackets, avoid IRMAA surcharges, reduce future RMDs, and control your taxable income throughout retirement. Now, here's what ties all of this together. The people who have the smoothest, lowest tax retirements aren't the ones who maxed one account for 40 years straight. They're the ones who spread across all three buckets. Tax-deferred accounts like the traditional 401k and traditional IRA, where you get the deduction now and pay taxes on withdrawal later. Tax-free accounts like the Roth 401k and Roth IRA, where you pay taxes now and withdrawals in retirement are completely tax-free, and taxable brokerage,